Wanted to welcome everybody to episode 2. Welcome to the Impact School of Money, where our mission really is to change the way that people are educated about money. And excited to talk a little bit on episode 2 today and share some thoughts, share some things that I've learned over 13 years and got a suggestion to record all of these to make sure that these can be shared. These can be shared later. So the 3 products we're going to talk about today. Last week we talked, or on Tuesday, we talked about level term, we talked about increasing term, and we talked about decreasing term. Today, what we're going to talk about is we're going to talk about a product called whole life insurance. We're going to talk about a variation of whole life that we'll just put over here because there's just one thing that's different, is variable whole life. And then the other one that we'll talk about, that we'll get into more details of the variations of this one next week on Tuesday, episode 3, is universal life insurance. But today we're just going to go over traditional universal life. So these are both very simple, can be explained very, very simply. Whole life. Here's how it works. You pick, you have your death benefit. So let's say it's $250,000 death benefit. In a whole life policy, they try to trick you. How long do you think a whole life policy lasts as long as you pay for it? Well, your whole life. That's how long it lasts, right? Really tricky. So, in order to get, let's say, a 30, 40-year-old gets a $250,000 whole life policy, there's going to be 2 parts of this policy. One is called the cost of insurance, and the other part is called the cash value. In order to fund a policy of this size, 30, 40-year-old, they would probably have to put in around $200 a month, assuming they're in good health. So as they put in $200 a month, is that what they're paying for their insurance? No. What goes to the cost of insurance is a preset amount, and in whole life, the amount that goes to the cost of insurance is a fixed amount. Okay, how do they calculate that fixed amount? Well, most whole life policies are going to be calculated to age 100. So if today I'm 30, they go to age 100 and they take the cost of an annual renewable term, which is how every type of insurance product is calculated. They take the cost of an annual renewable term. They go from 30 to 100, which is 70 years, and they add up what that cost of that would be, working in a few dividends and interest, and they have a special calculation, and they basically divide it by the 70 years so that you can have a fixed amount that goes to the cost of the insurance every single month. Okay? And then let's just throw out a number, and let's say that amount is $50. So $50 a month, or $70, or whatever it is, goes to the cost of insurance, and the rest, in our example, $150, goes to the cash value. As the cash value builds over time, there comes a point with cash value and then what a lot of whole life companies will call a dividend, where you're getting a dividend from the company, but then you dig into the definition of what a dividend is in insurance to make sure that, hey, is that something that whiteboard very blurry, says John Newton. Sorry, I don't know how to make it not blurry, but thank you for letting me know. I'll put it closer. Maybe that helps, maybe it doesn't. Lighting's interesting sometimes. Anyway, so we'll keep going, and we'll maybe figure this out. Try to maybe do it all on PowerPoint, get a different angle on the camera, something. Okay, so 150 goes to cash value, and that then builds. Where this money sits in a whole life policy is called a general account at the insurance company. General account. And it earns most places somewhere between 3 and 4% traditionally. Okay, 3 to 4%. The goal of a whole life policy is that this builds to the point where there's enough cash in there that it can start paying for itself, and I don't have to continue putting in my $200 a month. Okay, so that is the basics of a whole life policy. If I want to get money out, that is the benefit of any permanent insurance policy, which permanent is going to mean it's owning the life insurance. Term is going to mean it's renting the life insurance is the best way to think about it. Permanent is owning, term is renting. If I want to get money out of a whole life policy, in the tax code, the way I'm able to take advantage of this is through a policy loan that is non-taxable, that I can take from the cash value, that I'm basically borrowing from myself. Now, in depth, a lot of depth of how these work would take a lot more time of how the interest is calculated and how that loan is paid back in a sense. But in whole life policies, which is different from universal and their variations, is there is a positive interest rate, and the money would need to be paid back, but can be paid back through the policy itself. So that is a whole life policy. If you die, there's a death benefit. If you live, there's cash value that can be used as long as it's taken outright, income tax free. So next one, variation of a whole life policy is a variable whole life policy that most of the time in an insurance product, if there's another letter at the front of the type of insurance that it is, it just explains a feature in it. Usually in insurance, it's something that has to do with the cash value. So variable means that instead of the cash value being in the general account of the life insurance company, where they're taking the risk and taking the risk off of the client or the investor, if you want to call them an investor, and the cash value can now go into the market. So it still is a whole life policy in the way that life insurance policy is structured, but then the cash value is actually in the market. You can pick your investments just like a 401k where you have your little pie chart, and this much is in equities, and this much in bonds, and this much in international something, and this much in small, mid-cap, whatever. You have your choice of investments, and that's a variation of a whole life policy called a variable whole life policy. Okay? Last thing for today is how universal life insurance works. Universal life looks very similarly, and hopefully the black maybe shows up a little bit better. How universal life works is you have the same two pieces. You have the cost of insurance, and you have your cash value. As you pick your death benefit, just like all insurances, the bigger the death benefit, typically the bigger the premium, the monthly amount that we're putting in. So say we get a universal life, $250,000, and we're putting in $200 a month into that. One of the reasons that the universal life policy was created was that this is a fixed payment. This gave people some flexibility. Where in universal life, there's going to be a maximum premium that someone can do. There's going to be a minimum premium that people can do to keep the policy going. And instead of doing a calculation and dividing it by however many years to get an average and charging a fixed cost of insurance, in a traditional universal life policy, the cost of insurance is based on something called annual renewable term. So if in a whole life policy, the first year $50 goes to insurance, in a universal life, it might be 9 or 8 or 11, but it will be lower, same health, same person, different policy, because it's going to slowly renew each year as the person gets older. So maybe it goes from $9 this year to $10 the next year to $11.50 the next year and so on, because it's an annual renewable term. They get to keep the same health rating, but they're a year older every year, and therefore the cost of insurance gets a little bit more each year. So the funds in the cash value are in the general account of that life insurance company, and that's usually where universal and whole life companies try to be competitive, is boasting their internal rate of return or what their general account does. But on average and typically, we're looking at a 3-4% return. They might say, well, with dividends, it's more, but a dividend is not guaranteed. These are a guaranteed amount, and so that's what most people are looking at when they're looking at traditional universal life or whole life. So the biggest selling point, I guess you could say, in universal life was the flexibility in payment instead of the rigidness of having a fixed payment every month, where they're calculating everything on the minimum. So if my minimum down here is $50 a month, well, if I'm putting in $200, every time I put in that $200, I'm putting in 4 months worth of the minimum. So after 3 months of putting in my $200, $200 this month, the next month, and the next month, I've already met the minimum for the year. So if I call the insurance company, you fall on hard times, have an emergency, whatever it is, the person could say, hey, insurance company, I need to stop putting money into this, and you'd be fine. Where here, you wouldn't, and you risk lapsing the policy in the early years, again, depending on the policy you have. Where you die, there's a death benefit. You live, there's cash value that you have access to through withdrawals, which most whole life policies that I've run into do not allow any type of withdrawal. Is that equal among all of them? I'm not 100%. There's so many different companies to try to keep track of all of them. I couldn't say they all work this way. But the majority, well, all of them that I've seen, loan is the only option. In universal life, you can take withdrawals of the cash value, or you can take policy loans. And depending on the company, depending on the policy, there's different types of loans you can take where the net cost of borrowing, that interest rate, we've seen as low as 0.6% in the initial years, and then you get to a certain point in the policy where we've seen 0% loans against the policy. So there's different types of death benefits, there's different types of features that can be added to these, there's variations of universal life, but the purpose of today in our How It Works section is to really understand just the basics of whole life, the basics of universal life, and from there we can get a little bit more in depth. So thank you for joining us today. Again, today was episode 2. I'm Adam Davis, and thank you for attending class today here at the Impact School of Money. See you later. Have an awesome day. Make it a good one.